Hello.
Thank you so much for coming to our studios.
Of course.
Dan, I want to start with something different, the commodities, and especially with wheat and soybean and corn, and the impact of the drought in the United States on these kind of commodities. It's a different, I know, twist, but let's start with that.
Sure. The recent droughts have certainly sent corn up enormous amounts. You see wheat going up too. And of course, the unrest in the Middle East is sending oil up. And all these events are sending the nominal price up, but of course everyone thinks that this is the proximate cause. What I think is very interesting is if you look back at the 1970s, you saw the same kind of events where commodity prices went shooting up because of the oil embargo in 1973, because of the Iran crisis in 1979, but the real cause...
But is it only the Iranian premium? How about the
my point is that the real cause of the commodities going up is actually money printing. That's what makes them go up. But the proximate events are instability. There's always a reason why they go up originally, but they stay up. Right? I mean, think about the 1970s. Oil went shooting up because of these revolutions, but it never went back down to 1960s levels.
That's true.
So everyone thinks that the oil goes up because of Middle Eastern instability, and that is the immediate cause. But the fundamental reason it's going up is because of the money printing that all central banks on the planet are engaged in currently.
So are you saying because more stimulus is so-called, the more stimulus is expected, oil might go up even more?
Oh, for sure. I mean, don't forget.
Along with other commodities?
They've been printing money as fast as they can since 2008. And they've had a brief respite in the last year on behalf of the ECB and the Federal Reserve, and so asset prices are very volatile. But as economies weaken, I think the market is sensing that they'll have to act, and soon, as the Bank of England has already acted, and I think that traders are realizing that commodity prices are going much higher.
Fed is going to do a QE3. Is that what I'm taking from what you said just now?
Well, I think they're already doing QE3. Operation Twist is very easing. Remember, they're selling very liquid short-term bonds, and they're buying very illiquid long-term bonds. And this adds liquidity, but it's not even enough, right? The Fed has to keep increase money printing at increasing levels just to keep the economy from falling apart. So I think they're already doing that. They've announced they're extending Operation Twist, and I think at some point they'll do more easing. Whether they call it QE3 or something else, who knows?
Is that why we have been seeing a downward trend in gold? Gold being your expertise within the last 3-4 days, because dollar is negatively denominated against the commodities, and gold being one of the commodity. What do you think about that?
The short term in gold is certainly determined by more liquidity flows than the fundamental reasons behind the economy. But if you think about gold, right, in 2001 it bottomed at $250 an ounce. By 2008 it shot up to 1,000 and then pulled back to $750, and all the gold investors were ready to jump out windows, right? Even though gold had tripled against the bottom, right? So where are we now? 4 years later, after 2008, gold runs up to $1,900 an ounce, and now we're back to 15 and change, right? We're double where we were 4 years ago, and all the gold investors are remorse. They want to kill themselves. So,
are they right about being remorse?
Well, no, of course not. I mean, gold has doubled in 4 years. That's an incredible
So you're bullish
return.
Going forward?
Oh, yes.
How bullish? So. Give me your take for the outlook for the year end.
Well, I'm not going to give you an exact number, but I think the Fed, as the economy weakens, and it's clearly weakening, is going to have to act. They're going to have to add liquidity, and that is what will send gold up multiples higher.
When do you expect Fed to act in terms of the liquidity? Past August? After August?
Yeah, it's an interesting
Before
question.
The election?
Well, that's the question, because the sooner it gets to the election, the harder it is for the Fed to act withoat appearing to be political. Now, Bernanke says, we're not political, we'll act in the best interest of the economy. We know that's not true. If you read the memoirs of Arthur Burns or books about Alan Greenspan, we know that the politicians have an influence on the central bank and that they think about those sorts of things, because the Fed needs to defend its legitimacy as well. So I think the Fed is hoping that Operation Twist takes us through the election, and then my guess is they'll act around that.
Do you agree with that? Do you think it's going to help the equity markets and other markets get a relief?
Put it this way, I think without Operation Twist, the equity markets would be in free fall. So, so a lot of traders think it's not helping because the markets aren't going up. What they don't realize is that Operation Twist is preventing it from plunging down.
But is the economy really bad enough to act? Because I know from the housing data to the retail sales and the manufacturing, we've been receiving some negative data, right?
Oh, absolutely.
Is it going to, do you think, be sufficient enough for Fed to act?
I think so. The only question is when. The only question is how long does the Fed act? And don't forget, Bernanke, as a Princeton professor, wrote many papers about how wonderful it was to print lots of money. Right? And the longer he waits and the worse things get, the more money he can print, the more money he'll have political cover to print.
Okay, from money, let's go back to the gold, because you had a beautiful article at the Forbes magazine about gold mining stocks.
That's
and
right.
I remember asking you this question last time too, because gold has been performing really well, but the gold mining stocks have been lagging that trend. Why, right? That's what you're talking about here.
No, that's exactly right. And what's interesting is that the profits of gold mining really have more to do with the gold commodity ratio than just the gold price, right? If we think back in the 1930s, gold was $35 an ounce, oil was 67 cents a barrel, and gold miners were incredibly profitable, right? So it doesn't matter about the absolute nominal price of gold. It matters about how much does it cost to dig it up. And the cost of digging up gold and processing gold are mostly based on industrial commodities. So it's that spread that makes the difference in a profit situation for gold mine. If we think about what happened in 2008, right, when the markets were melting down, the gold was going up vertically against oil, against copper, against all the costs of gold mining. So even while the gold mining stocks were going down, the value of their assets were going up. So it made it a fantastic time to buy the stocks, right? And now we see in 2012 the exact same thing happening. We see the Fed's not printing fast enough. Liquidity is erasing from the market, so the stocks are having trouble. But at the same time, gold is continuing to climb against the cost of mining it.
That's what I mean, the operational costs.
That's right. So lots of analysts look at the costs of mining and they say, oh, look, the costs are going up. And they're right, the costs are going up in mining. But gold is going up even faster. And
so that should have been kind of balanced, net off.
It is, for sure it is. But the equity prices in the short term are driven by the capital flows and liquidity levels, and those are very low. So what that does is it makes the stocks cheap. It makes it an incredible opportunity to get involved now.
What's the PE?
Well,
in terms of the general index.
Yeah, well, most gold companies, people look at the operational cash flow as opposed to the PE, because they're always reinvesting.
Because I want to know how cheap they are as opposed to their earnings.
Well, there are a lot of smaller gold companies out there that are trading at 2-3 times next year's.
Can you give us some names?
Operational cash flow. Well, I prefer not to, because I'm not supposed to do that. But there are, a few big gold companies, and there are dozens of smaller ones. And the smaller ones are where the real opportunities are. But even the big ones, Goldcorp, Newmont, Barrick, they're down roughly a third over the past year, even while their operations and their asset values are going up. So even those which aren't as operationally levered to the gold story are still incredible deals at the moment.
How about the SPDR, the index fund? Would you, as an investor, make an investment in these kind of funds?
Well, I prefer to look at the individual companies, because if you buy a SPDR, all you're really doing is buying a mutual fund that someone else picked the companies for you. And I think one of the important things when investing in gold is to understand that the reason investors look for gold is they're worried about instability. And a lot of the index funds have companies in shaky jurisdictions. Right? There's no point in owning a gold mine company in a country that's going to nationalize the mine, right? I think it was Bolivia last week nationalized South American silver mines. So it was a great project. The numbers all looked well, but all of a sudden, poof, it's gone, right? So you have to look at the underlying companies, where they are, what the jurisdictions are, and be very careful.
I want to take your opinion about the gold market, the demand in the emerging markets, including Turkey.
Yeah, well, it's interesting. If you look at Turkey, if you look at places like India or China, the gold price there is going up much faster than in US dollars. And the reason is because inflation rates are much higher. And the citizens of those countries usually have fewer choices where to put their money. For example, in China, the average person cannot take their money and put it offshore. So they have very few options where to save their money. They don't want to put it in the bank because the interest rates are so low and inflation so high that they lose their capital. So there's a huge demand for gold in those countries. And I see a lot of analysts who say, oh, the gold in terms of rupees is up so much. It's so expensive that Indians can't afford it anymore. And I look at the opposite. I say, well, look, the higher gold is going in rupees, right? What it means is that the faster the rupee is depreciating, and the more their incentive there is for Indian savers to go and put their money into gold and not into rupees.
Perfect, thank you. And that puts an end to our conversation here. Thank you for coming.